February's unemployment report came in hotter than expected. The economy added 311,000 jobs. What does all this mean for the markets and for the Fed? Let's bring in Principal Asset Management Chief Global Strategist Seema Shah to discuss. Seema, it is great to see you. We're actually seeing stocks turn up a little bit here in the U.S. in the wake of the report, and I wonder if it has to do with that wage number. How are you reading it, and what is the read-through for markets?
Yeah, thanks, Judy, for having me on. Yeah, it's an interesting report. So I think the market is focusing not on that job, that 311 increase. They're really focusing on the average hourly earnings. They're also really looking at that unemployment rate, saying it's larger increase than expected, which is telling us that maybe the labor market is loosening a little bit. I mean, we have to put it in context. 3.6% is still an incredibly low unemployment rate. But at least at the margin, you are seeing potentially a slight loosening. And it does suggest that maybe the Fed doesn't need to hike by 50 basis points later this month.
And that was my question. Do you think that the Fed will be hiking by 25 or 50 basis points, or do you think it will also need the data coming out next week to determine what happens?
Yeah, Powell, he's had a couple of confusing messages, but he was very clear about one thing when he spoke at the testimony, which was that the data between now and the March meeting are incredibly important. They are very much a data-dependent Federal Reserve at the moment. So this jobs report was, of course, one segment of it, which is very important. But given that the jobs report hasn't really given us a very clear picture of what the economic situation is, we're now looking to the CPI inflation number. And that as well is going to be very important to decide, is it going to be 25 or 50? At the moment, I think it's fairly balanced. We can see from the Fed narrative that maybe they are starting to move towards a slightly more hawkish side, towards the 50 basis points. But given that they had just stepped down to 25, I have to assume that there's a slightly high hurdle to get to that 50. So if we do get a CPI number which is in line with expectations or certainly softer than expected, then I think that 25 basis points is back on the table.
What is the game plan then for investments, right? If there is the potential here, whether it's 25 or 50, we know the Fed's going to keep going. That's what Powell has indicated. Does that ramp up the recession risk? And then does that mean markets are or are not appropriately pricing that in?
Yeah, Julian, I think you said the really important thing here. We're talking about the 25 and 50, but really the big picture is that we know that the Fed is not going to be stopping in their rate hiking cycle for the time being. We know that they've got further to go. The other very clear message that has come out from the Fed is that they don't expect to be cutting rates at any point in 2023 because they just simply don't have the inflation space to do that. So then, you have to turn to investment markets and say, look, well, the equity market has been rallying fairly hard through much of the start of this year. And it seems like it hasn't taken full appreciation for the fact that the economy will eventually feel the negative repercussions from these rate increases. So to us, that means that earnings growth is going to be challenged as you get further through this year. It means that margin compression is going to be a really key theme here. So companies are going to be struggling more and more. So for us, putting that together, that suggests that equity markets probably are in for another leg downwards. And it's really important that investors start to look at their portfolios and try and seek some kind of safer assets within there to balance out the risks that they have.
Seema, if companies are paying more for workers now, even though we did see that wage growth slowing a little bit, could we be seeing a recession where you still have a relatively strong labor market, at least in some areas?
That's very true. So, from our forecast, when we look at the unemployment rate today at 3.6%, we're only expecting it to rise to around 4% by the end of this year. It's still a very, very low unemployment rate. So it's not going to feel anything like what we've seen in previous recessions. This isn't a downturn that we're expecting to rival anywhere close to what we saw for the great financial crisis. And as you said, there will be certain pockets of the market, of the economy, which will probably fare okay. We think that services is the area which may be relatively unscathed, manufacturing probably a part which is more interest rate sensitive. So there will be pockets which will not suffer as much, but from the aggregate side, we do think that recession is unfortunately going to hit the US economy late in 2023.